So we are going to cover today a revision session of governance factor. I will try to cover the session with 2024 new curricula. Of course, you need to watch the detailed video which covers it in two parts, and it's uploaded on our system. And those has more detailed discussion. So what we are trying to cover here, 2024 update, an overview of governance factor in ESG investing. To start with, let's understand there are 6 critical concepts which we have to learn in governance factor in CFA ESG curricula. First, that you need to assess key characteristics of corporate governance. So be it a board of director, be it independent director, or a decision-making process, you have a say. In that case, this becomes very critical that you can judge your own company's key effective governance or the company where you are investing. So that's the part one which we will learn. Second part we will learn about is board structure, diversity, effectiveness, and the independence, which is anyway we have learned through different programs in past. Then we will go into executive remuneration, performance matrices, and the key performance indicator KPIs, how those works and interrelate. Finally, we will look into reporting and transparency and international, countries' corporate governance, not one, at least 6, 7 we will see. And in detail video, we have covered most of the critical and important countries across world who has created a state of, the state of art, or you can say best practices they have adopted across the world. So that is what we are going to cover. Let's see the learning outcome. So in this chapter 5, module 5, social factors, we have 6 learning outcomes, which, CFA Institute wants you to learn on ESG. First is we have to understand the evolution of corporate governance framework itself, that where from it came, what kind of roles and responsibility it assumes, what is the spirit of law in terms of system and processes, which suggests that how you should engage your shareholder and aligning the minority shareholder. Second part, of course, learning outcome suggests that we should understand the characteristics of effective corporate governance. So what all it includes, where we will learn about assessing the key characteristics of effective governance, like board structure, diversity, effectiveness of independence, executive remuneration, performance matrices reporting, etc. Then we will go into models of corporate governance. So we will assess that and contrast the main models in corporate governance across major market, and we will try to identify the variables influencing the best practices. Then we will look into role of auditors in corporate governance along with governance issue and investment opportunity. We will try to cover that roles of auditor in corporate governance, what challenges they face in the age of AI and technology disruption, how the audit report need to be really aligned with the stakeholder expectations. Yeah. And where public finance initiative, company infrastructure, private finance vehicles, and how the societal impact of that is also coming through the governance structure need to be seen. So you remember there was a linkage between environment and social factor. Okay. If there is a climate change, the poor gets poorer and he gets more exposed to worse weather compared to the rich who has AC and other mechanism to control it or travel other part of the world where the cool and calmness is available. So the sufferance happens to the another community where you operate. So we need to consider that. When we come to chapter 5, through governance, we also look into the societal impact as well. That how a corporate operation and its governance impacts its employees' life, their family, employees' family, as well as the community around that company. Make sense? Yeah, if the company goes bankrupt, of course, in that area, all the operations which links to that business will go bankrupt too, right? Kind of. So this is how we need to understand, and then we finally need to look how to apply this corporate governance factor in real life. So let me start with the part 1 where we will try to cover introduction to governance factor. Look, formalized governance frameworks has been initiated first in UK and recorded. Yeah, which has been accepted by world, and slowly every country has developed their own, including US, Australia, India, etc. And they also launch certain kind of best practices where each country learns from each other now. Through the shareholder engagement and alignment, that's the basics here. Okay, the basic here is a corporate governance framework. We need to understand that how your corporate governance frameworks of a country interacts with the shareholder engagement and alignment with of the corporate. Yeah, corporate governance framework is a process. Let me define it. Is a process of managing and overseeing a company. Okay, so it's just not a documentation part. It's a rather a process of managing and overseeing a company shaped by local laws as well as culture of that area. Don't forget culture as an important part. And in exam, they will twist this language and ask you a question. Okay, they will say corporate governance is a process of managing and overseeing company. Full stop. Yeah, shaped by law. But if they have missed culture, you need to find in the options if why did they mention about culture there in the option. If yes, then take it off. Clear? Then we will look into the key tenets and trends in this area where accountability and alignment becomes the key. That who is accountable for implementing and how it aligns with the community requirement. Make sense? Because accountability is crucial, right, for overseeing any management and encouraging the efficiency and ensuring a long-term well-being of a business. Then comes the board structure and committees, which we have to learn in deep. Why you learn it, understand and learn it in deep? Because to achieve accountability and alignment, boards are expected to establish three independent effective committees. Three independent, these are basics ones, okay? Below this, not acceptable. Can anybody name those committees? We all are
NRC,
absolutely nomination committee and remuneration committee,
Audit Committee,
audit committee, and of
Risk.
course, remuneration can be independent too. Yeah, so nomination and remuneration you can separate, and these are the three basic committees which any company should have. Clear? Good job, Dr. Sirra. Then comes the what is governance in itself? Let's define that. To define and understand the corporate governance, we have to understand these five parameters. The first parameter is that governance is a process, right? Which is shaped by accountability and alignment of a company with the locality, government, society. Then comes why you need corporate or good governance. Because you see that leads to a strong business performance and prosperity. And this is the recorded history I'm talking about. The company which has a good governance tend to live longer than the company who doesn't have. And we have referred last time when we were discussing in detail videos, Byju's, Satyam's, Enron, all these case studies are available for us. And book itself gives you more than 10 case study that a failure in understanding corporate governance and implementing a good governance can result and give result, in disastrous way. Then comes the another parameter which we have to understand when we are understanding corporate governance is role of board members and the processes which they incorporate. See, at the core, corporate governance involves individual in boardrooms and their interactions. As simple as that. How these people, including independent like you, directors like you, and the board members, how they interact to each other so that they can have a good process and then you can have a good governance. Finally, the investment perspective need to be also seen, be it minor investors or minor shareholder or a private equity player. Assessing governance based on quality of policy is the best way to decide whenever investor looks into a company. So your policy, process, and procedure, these three are important part of good corporate governance infrastructure. Without this, you cannot have the accountability and nor you can have alignment with the societal values. Clear? And that is why two core element, which I have repeated thrice now, is accountability and alignment. Yeah, accountability definitely involves giving authority and then asking for responsibility, while alignments indicates that why your company should exist even. And if it exists, how it aligns with the social and cultural values so that it operates in a way which is win-win for all. And chain and circle of accountability, don't forget. Okay. This is one of the key steps you need to adopt to make sure that all challenges which comes to the good corporate governance operation and solution comes from the agency problem. Agency problem is a simple definition for agency problem is that a party who is operating the company should think about company, all board of directors, not only for themselves. Yeah, that's the agency problem. And that comes from the separation of their duty and accountability. And that's why flow of accountability, which is from bottom to up, need to be seen with clarity. And that's the chain and circle of accountability. One question can be definitely from this area, okay? Where the workforce at top, there is a management, and then you have a corporate board, then comes the fund manager, asset owner, and beneficiary. That's how it works there. Now let's go to the second part, which is the genesis of this corporate governance and how people have adopted it wholeheartedly and what benefit they have got it. So look, corporate failures, scandals derived the formalization of corporate governance and its development of code today. That's the basis. There is nothing else. Only the corporate failures and scandals. See, corporate governance codes, which are first made formal, came from UK, United Kingdom in 1992. Anybody remembers which was that committee which has produced this corporate governance formal code? Very famous one. Everybody takes that name. And we eat sometime too. Yeah. Kuch meetha ho jaye, you remember? That ad of Amitabh Bachchan or a girl singing a song, that comes from Cadbury, and the name of that committee was also Cadbury Committee. So in 1992, it was the first time they formalized a corporate governance code in United Kingdom. Then, of course, committee in governance, which became prominent, was audit committee, which oversees the audit reports, financial reporting, and risk. Yeah, that became the key part of the UK corporate governance operation, where the division of responsibility they have recommended, composition, succession, and evaluation they have recommended, and board leadership and company purpose they have defined. These were the 5 themes, including audit risk, internal control, composition of succession evaluation, division of responsibility, and board leadership and company purpose. These 5 themes has built into the UK corporate governance code, which was launched in 1992 by Cadbury Committee. Now, if you see board structure and its effectiveness, the first part you need to understand is, do board members have those required skills and experience to support the growth or the stage of that company? It can be in transition stage, it can be in transformation stage, it can be in liquidation stage. What we need to judge as a ESG investor, that what is that required skill at that point in time in that board is required, and does those people who are taking such a critical position have that experience? It doesn't matter that how many years of experience he has as an independent director or as a board of governance. Yeah, but what we need to see, that does he has a relevant experience? So relevant is a key word which we have to look into this case. Yeah, we cannot look anything else other than the their experience and the relevance of the same. Then comes the diversity. As I have talked in several times, that companies in ESG investing lenses, they always look through DEI, diversity, equity, and inclusion. So diversity in board is now undeterred phenomena everybody has accepted. And the moment you bring a diversity in your board of direction based on the gender, race, experience, immediately your effectiveness of board increases to multiple times. Yeah, it's not just I'm saying, it has been, there are some empirical study which are in place to making me say that. including you can bring race, gender, cultural nationality. These are the part which are part of diversity, which people brings into a board to get a better direction to their company. Then comes another critical parameter, which now it is mandatory for a lot of listed companies with a certain size, which is board appraisal and reporting of the same in the corporate governance reports. Clear? Appraisal is critical. Year on year, there has to be a report on the board itself. That how the board people are operating, what are their capabilities, what challenges they are facing, and how they are overcoming those. That a story need to be there in corporate governance report as well as in the audit report. Then comes checking on the board independence itself. Looking into board independence is critical. A lot of company fails on those ground. Yeah, including the big companies, except the professional ones. Yeah. Family businesses generally have these kind of challenges where the independence in certain time can be questioned. And Adani was one of those examples where in Hindenburg report it was cited. Yeah, because their auditors were so small and not means not as recognized as the company was. So that was one of the independence issue which they have highlighted, apart from other ones. Then comes the International Corporate Governance Network, ICGN. People swear by this corporate governance, global governance principle. This sets the spirit for all across world. What is the minimum requirement when you are following corporate governance? You can follow our own independent Indian Company Act 2013. They have a very clear-cut corporate governance guideline. But if you want to learn the spirit and see what new things your company acts will adopt in future, better refer the International Corporate Governance Network. Okay, they have their website. You can always go there, put their RSS feed, and keep checking what are the new recommendation or consultation papers are coming. And finally, when you are reviewing corporate structure and its effectiveness for ESG investing, look into length of tenure of these board members. Okay, very critical one. Let me give you some examples there. So, of course, in the detailed video, you will find it much detailed than this. But point here is executive remuneration, which includes conflict of interest and executive remuneration, has to be seen. Are you paying somebody who is not supposed to get paid to that amount? Need to be seen. And is there conflict exist? The clearest conflict of interest between management and shareholder lies in the executive remuneration itself. So that line always look into any audit report or corporate governance report. Second is divergent perspective on pay structure itself. We have seen several examples, right, in the beginning itself, that inequality in the pay of a CEO and an intern or executive in the company need to be seen with a greater care. Directors obligated to individual companies' success may prioritize securing top talent for their firm, potentially leading to increased pay. But does that increased pay give you the result which directors expected to have? Need to be observed. Make sense? That's the critical part, and you need to judge and remove it. One of the best example I have seen happened in Wipro, where they have hired one of the best talent in world in IT service industry. I think the person was foreigner. He came here, he tried to execute several initiatives and failed miserably in 2 years. Azim Premji and his son not thought twice while he was replaced with the internal growth engine. Okay, that was one of the examples. Then comes the trust issues and dispute in the executive reward. Please understand, lack of trust is stemming from misunderstanding between investors, be it minor investor, and the corporation fuels the dispute over the executive reward. And trust me, you will face a lot of question in your annual meeting on this regard. And then comes the maximum tenure of IDs. You see, if you 12 to 15 years, no independence, certain company we have found out with. So this is one of the analysis which the CFA curricula gives, where you can find out on an average 5 to 7 year in Argentina, Turkey, China, and Russia. No independence can be seen there. If the people are exceeding 8 to 10 years, they need to explain. That happens in Indonesia, Singapore, UK, Hong Kong, Again, China, it's a part of China, Ireland, Italy, and Malaysia. But if you have 8 to 10 years and no independence can be recognized, that country is India. Okay. So India comes in this level where if you exceed this number, then it will be assumed that there is no independence. Estonia, Greece, India, Israel, Latvia, Lithuania, Peru, and Saudi Arabia are those countries which has adopted these kind of rules and regulation, yeah, which denotes the code. Then 12 to 15 years, few countries means which are in black, they do not have a code, but they have understanding of this. 12 to 15 years, if the board of director is same or independent director is same, it will be counted as no independence. These countries are Belgium, France, Luxembourg, Poland, Portugal, Spain. They have a code for it. Denmark, Slovak Republic, and uh, Slovenia. These countries doesn't have that code, but they follow the same. So this is what are the component of executive remuneration? Of course, fixed salary, benefit, annual bonus, and share-linked incentive all will be counted as executive remuneration. So you cannot separate share-linked incentive saying that it is a vesting period and it should not be counted as his salary. It has to be included whenever we are talking about executive remuneration. So what are the issue? See, the conflict of interest in the executive remuneration, as I have highlighted, is a critical one. And why it comes? Because different mindset between the board and the minor shareholder has to be understood. Then comes the variable incentive. If the company is giving variable incentive, there will be a lot of issues which shareholders and boards will be talking about. Then comes the lack of trust, as I have explained you. Lack of trust is stemming from the misunderstanding between investor and corporations fuels the dispute over the executive reward. And it will be always question, and maybe they will request you to remove those people where the lack of trust exists. Then comes the disconnect between the in expectation and connected contractive incentive versus market performance of share also need to be seen, because sometimes the shares might be going down and his salary looks lower, yeah, while the contracted incentive is might be very high. So these kind of challenges need to be seen when you are looking into ESG investing through governance lenses. Fairness concerning executive pay, that how the equal company is and how they are distributing the remuneration need to be seen. Pay ratio disclosure is clear and most important aspect any investor is looking for. If you see, then comes another topic of very importance and pertinence is reporting and transparency of corporate governance. Everything starts from here only. So Principle N of 2018 Corporate Governance Code says very clearly, the board should present a fair, balanced, and understandable assessment of company's position and prospect. What are the issues here? That you might be masking weak performance of corporate governance in your company. You'll try to just dodge those questions which are critical in nature. Then comes the alternative performance matrices, which has to be understood and clearly identified. Inconsistency between the narrative and financial reporting creates a transparency issue. Please understand, people reads it very clearly. And that's why in sustainability reporting lectures, we discuss about this particular aspect, that inconsistency will highlight that either you have a weak team which is sitting on the reporting seat, or your company is trying to mask some stuff. And then comes the climate change itself, which impacts the reporting and transparency, where the monumental impact of climate change might not have been recorded or underreported while we are reporting the corporate governance, has to be seen with that lens. Then comes the financial integrity and capital allocation. See, capital allocation decisions are generally lies with the board. And the corporate governance policy do play a bigger role here, that who will take an independent decision in such kind of capital allocation. Then comes the distribution to shareholder, dividend, etc. need to be seen that it is happening without any prejudice. Then comes the reinvestment into existing or new business, and business activity is also critical issue which falls into this area, along with the capital structure, where the shareholder considerations, shareholder buyback, issuance of share and dividend payment need to be properly documented and reported whenever we are talking about business ethics. Now, see, business ethics has its own issues, which we have to understand very clearly. The first part of the business ethics comes from the corporate culture. What kind of culture they have? It's a family business, a lala business, it's a ghotala business. Whatever kind of business it has, we need to see that it enhances social inclusion and creates an active citizenship along with the personal development of people in and around that company. Okay, it should not be toxic culture. Definitely that kind of company has a business ethical issue. Yeah, where diversity, equity and inclusion is not considered, again they will be hanged till death kind of situation in corporate culture when you are evaluating any ESG investing. Treating employee fairly is the key matrix here, along with offering value to customers. So not only employee, you have to also see that employees and the management is respecting customer. Okay, the transaction between customer and the management is on equal footing. Definitely you should avoid the discriminatory or other explorative behavior when we are interacting with customer. You can make 100% from the customer, make sure he gets the value out of it, which is 200%. As long as you do that, your customer will be there, and so does the company. Avoiding bribery and corruption is a key tenet in business ethics, and that's why tone at the top has to be very clear and documented, where the whistleblower policy, etc., is part of that operation. What we need to understand, we need to ask one more question here. Does the business identify the skill and competency to deliver its strategy at board and management level? Has to be seen as well. Another point which is in the sequence of treating employee fairly, offering value to customer, avoiding bribery and corruption, the paying supplier appropriately and promptly is also a key factor. Very few people try to respect that. But eventually, if you don't have that payable and receivable days equivalency, okay, based on the industry prevalent acceptance rate, you will be always exposed to sudden supply chain disruptions. Who knows whether that? Yeah, Santosh ji, you agree, right? Even Dr. Sriram should agree. Both of you comes from that sitting position where you see all this SCM disruption all the time and how that makes a company go bankrupt too. Clear? Any question here? Okay. Now let's go to look into another issue in business ethics, which starts with developing relationship with local community. Yeah, this is the link between corporate governance and the social, where as a business ethics and operational parameters, policy and processes, you need to make sure that it is well documented that you will develop good relationship with the local community. Approaching regulatory or political lobbying activities honestly is a word which they have used because they consider the lobbying is a ethical part of business operation. Yeah, you should always approach regulation and regulator with your problem which it exists rather than work in the silo. Clear? Paying fair and appropriate level of tax. See here, fair and appropriate is keyword. They are not saying pay the actual amount, whatever tax comes. Yeah, otherwise tax avoidance and tax dodging might not be word which exist in the world. Then comes the acknowledging the value of company reputation. Okay, that you need to make sure that people understand what company exists for, what are its core competency and how it gives value to the world, to all is a stakeholder. Not world is a very generalistic term, but all is stakeholder, including employee, regulator, government, as well as somebody was today talking about that India government gives if you are earning, you are a salary class and you earn 10 rupees, 7 rupees government will take from you. Yeah, only 3 rupees is kept in your pocket for fight in real economy. Of course, in not nominal economy, we are talking in real economy. But point here is Does that company understand and remunerate accordingly so that even though it is 3 rupees is left, but that is enough for you to survive for a month? That is what company has to look for. The next segment talks about structural corporate governance. Okay. What I will try to discuss here is that what are the several major world markets and how they have adopted corporate governance in what factor. Let's start with the basic idea about it. So corporate governance across world changes based on the culture and value of that country. For example, lobbying. In India, official lobbying was allowed through corporate government bonds, right? Electoral bonds, which we have launched. But slowly that also, our judiciary has observed there is a discrepancy there and they stopped. But point here is in US, this is a completely accepted process where the lobbying is allowed. So each race, each culture has their own lobby system, which interacts with their senator, and that senator influences the federal government to get such kind of association. That difference we have to understand. So the division between supervisory board and management board on the company level is critical here, where everything starts. Then comes the board structure. Every country has different kind of prescription here. Along with two-tier boards, Germany and Netherlands, Scandinavian countries, including China, and China has a single tier boards. So Germany has double tier, and then all these countries has the single tier board. The UK, United States, Japan, France, and most of the rest of the world, they are following single tier. So two tier, Germany, Netherlands, Scandinavia, and China. These are the countries. Then single tier board is UK, United States, Japan, France, and most of the rest of the world. That they follow single tier. So there is only one board, right? In India, it's only one board. But if you go in Germany, you will have a labor board separately, and then the company where the they have a interchangeable as well. So labor union also has their own board with the government, setting equal footing to the board who has started a company. Clear? Now, international social factor, these are the review. In detail, if you want to watch, you need to refer the detailed video where we have gone to each of the country. Let me take some critical country here because this table, which summarizes the structural corporate governance differences in major world markets, is very interesting to read. Books goes in quite detail. I have just summarized it here, by the way. Yeah, because it highlights that key governance feature in Australia, finance, and Germany, how they differ to each other. The variation in board composition, election process, shareholder resolution, and unique aspect of governance in each country, which you can observe from this slide or next three slides. Additionally, it emphasizes the absence of universally superior governance model and the influence of legal histories. So you cannot say Australia is better, UK is better, US, United Nation is better, United States of America is governance structure is better. You cannot say that. Yeah, because everything is based on the legal history of that country, culture, in which that company also contributes governance practices and creates a worldwide structure. For example, let's take Australia. It has a single tier board arrangement. First of all, single executive director will be there, which is managing director. And then you have board typically have 6 to 7 directors in Australia. CEO usually is not subject to election by the shareholder. Rather, annual election for non-executive director happens in that country. Shareholder resolution is common, influenced by strong investor presence there. Here, governance is expected to work on the principle of comply or explain situation. So either you are complying or you are giving a reason why you have not complied approach. Yeah, with a confrontational relationship between company and shareholder. So both can confront to each other while they are looking into comply and explain. When you go to France, mostly it is single tier, but there are certain companies which follows the two tier as well. Okay, combined chair of chairman and CEO is common there. So CEO can be chairman as well, where the 40% female director is recommended and accepted. Third, and the third is employee representative out of full composition. One third will be one representative, which is coming from employee side. That's an interesting structure, right? So shareholder vote on related party transaction is a compulsory arrangement requirement for joint auditors like Big Four or next year firm is also important. Yeah, so joint auditor is a concept which is accepted. Sometimes it is good because they can challenge each other, which helps the company and minor shareholder to understand how company's audit has happened. Double voting rights is available for long-standing shareholders requiring two-thirds of the vote. Yeah, those people can have a double voting. Controversial Flagrants Act allowing management control through double voting rights is one of the interesting corporate governance article which everybody should learn and think about. So this is just a assignment which you can take. Just go to Google and find out Florence Act. Yeah, and how it impacts any company corporate governance. Then comes the Germany, one of the best standards in corporate governance. The challenge is there also we have found a lot of controversy. And one of the worst controversy which I have learned was Volkswagen. Yeah. And this was again, there was a conflict between both the board of directors. One of the board in two-tier board was completely unaware about this mismanagement which were happening at the company level. Clear? So this was another learning for Germany corporate governance structure as well, where the shareholders can appoint half of the supervisory board, other half comes from the workforce. It's called co-determination. Then comes the supervisory board is accountable to shareholder. Clear? Shareholder votes on management remuneration through advisory votes. You're seeing the link here. Yeah, little complicated, but very interesting that shareholder can vote on the management remuneration, but through advisory votes, not the direct vote. 2-year gap is required for executive from moving from management to supervisory board. Not everybody will be allowed to take the management role, CEO in one day and second day you are board of director. Not allowed. Yeah, 2-year break is required in between this process. Supervisory board holds management accountable. That's their responsibility. And they approve major transaction. Here, controversial argument, if you want to learn, is supervisory board share availability for discussion with investor. Yeah, there is a quite interesting case study which you can learn here. Then comes the global observation. If you see, it varies all across world. There are different kind of operating a structure in corporate governance. No one model is superior. Yeah, models shaped by the legal history culture, international best practices incorporates into government initiative like IGCN practices, ICGN practices, and OECD principle. These are the two major influencing factor which creates the spirit of corporate governance across world. Investor expect companies to adopt international best practices irrespective of which company you operate. So OECD corporate governance fact book provides those kind of details which you can pick it up and put into anybody's books. Governance structure approaches in 49 jurisdiction right now is following in 49 country OECD principle. Okay. Then comes the Italy. Italy has a single board. Japan has a mixed board. Netherlands has supervisory board. Sweden has shareholder control and UK has a single tier board. Again, there are small nuances which you need to learn. For example, in Japan, the requirement for at least 2 independent director, which comes from non-executive side, like Dr. Sriram or Dr. Santosh or Nilesh, they can pick up those positions on every board it is required. So there the requirement is much larger than the India, even though we recommend here independent board of directors minimum one. So these are the small differences which we have to note and understand. For example, in UK, goal for greater female representation has been already prescribed and described, where the inclusion of direction from minority ethnicity on board is also made compulsory. And that's why you will see in most of the boards nowadays, Indian, Pakistanis, Algerians are there on those company board through this route. Clear? USA, we have to understand in detail because particularly corporate governance landscape in last 20 years has drastically changed in USA. Even though they are latecomers into the party, but they have learned their hard lesson impacting world with their corporate governance failures. And thereby they have a stringent Sarbanes-Oxley, all those recommendations which are in place, which makes US state-based laws also important to understand when we are talking about corporate governance. Okay, the absence of countrywide corporate governance in US is also quite interesting to look into because influence Here the influence is market-led best practices and federal regulation which comes into play. So mostly it is a regulatory law which impacts the corporate governance in US rather than just independent. And that's why Delaware is one of the state in US has a interesting, and it is a dominant state for corporate incorporation, by the way. Most of the Indian company first try to register in Delaware because in $500 you can register your company there. Clear? Influencing US corporate standard in the big way because it is a leading market-led best practices. What are those market-led best practices? It starts with the common sense of corporate governance principle. They have a document in 2016 they have incorporated, and 2018 they further revised, which focuses on inner working of the board and board effectiveness with the alignment through pay. So they make sure that payment is the linkage between board effectiveness and their performance. So kind of performance-based space which gets recommended to the board of director. Then comes the investor stewardship group corporate governance principle. In 2018, it came into play where the emphasis on relationship between companies and shareholder has been discussed. Council of Institutional Investor Corporate Governance Policy is another area where detailed approach to governance issue by long-term investors. Yeah, where the federal regulation on security like by law, US Security and Exchange Commission, US SEC has brought in. ACC has set a standard itself for audit committee. Very interesting audit committee independence and skill requirement is there from Dodd-Frank legislation which came as an example. After this happened after the Dodd-Frank has prepared the report after the financial meltdown in 2007-8, where say on pay vote every third year. Okay, it's very good fundamental there. Say on pay. Look into this also your Google or ChatGPT and find it out what it recommends with the option of more frequent votes. Okay, then comes the another concept SEC Dodd-Frank has recommended is access to the proxy standard. Okay, where the eligible shareholder can add a candidate to the proxy statement which can give some positive dynamic to company. And then the other argument is shareholder relationship with increased availability of non-executive director in the shareholder meeting. These are the critical stuff which anybody has to learn whenever they are talking about corporate governance structure. Now let's go to the audit side of it, which is also very critical to learn. What I will do, I will go to the detailed slide for the same because, even though it looks very minimal, but I believe all part of that need to be seen and absorbed well. Once my screen is visible once again, please let me know. And we will go straight to this corporate governance last three slides directly from our main file, which includes the corporate governance, corporate governance through, just a minute, let me stop the sharing. Okay, so see, the corporate governance and the independence audit function need to be seen in a tandem. See, there is a historical context to it in 17th century where the trading businesses started like Dutch East India Company, etc. They have realized over a period of time that a specific trade journey or set periods requires accountability to the board. Accountability for the performance and sharing proceeds because shareholders do exchange that point in time share scripts. Then comes the Industrial Revolution, which started in 1760 to 1840, where the rise of large-scale corporations seek external capital. The moment you seek external capital, auditor and independent function becomes the critical, specifically the auditor's independence. Okay. And then, of course, rising of large-scale corporations seeking external capital with annual reporting and EGM was made mandatory. Yeah, the response to failures was first one in UK 1840s where railway boom scandal came in play. Lot of frauds has happened on the script level, where the losses for minority shareholders were enormous. And that's how the introduction of independent audit for shareholder assurance came into play. That whatever company is saying, it does make sense and has some kind of reality check. Yeah, auditor, of course, doesn't do the 100% check. It's a sampling check with the assurance that whatever management is saying is in line with what is prescribed by the regulation and the law of that country. And that is why it is a modern concept where auditors' role hasn't changed in the model concept as well. They are the independent party which is looking into independent assessment of financial report. Of course, sampling process for identifying the anomaly has improved a lot in recent time with the computer and AI comes to play. They work as a watchdog, not as a bloodhound. In 1896, UK Court of Appeal of Judgment established that. Okay, so any auditor which deserves your lot, please remind them this particular 1896 UK Court of Appeal judgment, where they have been identified as a watchdog, not as a bloodhounds. When it comes to GSG, ESG reporting overview through the lens of this independence of the auditor, we need to see that there is a lack of global uniformity in the standard itself. And thereby, increasing emphasis on sustainability report has taken place. So no longer for ESG reporting purposes, only audit report is valid. You need to look into sustainability report. And thereby assurance to ESG reporting also has become critical, and Indian government has now allowed all Indian chartered accountants to do so, along with some independent people which has an international affiliation, even though they do not come from the chartered accountancy background. Independent examination and third party assurance is critical part. Impact on governance, risk management and control is also a part of assurance of ESG reporting. Key element of ESG report remain scope, timeline, methods. Examples of evaluated issue need to be reported there. Challenges and voluntariness is critical because lack of universal regulatory standards and differentiation between management system standard and guidance. This creates a little bit of confusion. However, enhanced auditor report is accepted now, which means you have to do the sustainability report assurance as well. This was the first introduced in UK, where the enhanced auditor reports are now globally adopted. Where the crucial element of enhanced auditor reports include the scope of the audit. They have to mention very clearly, identify the material topics and materiality of the topics which they are reporting. And finally, they have to mention key audit matters which they have audited, checked, and verified. Upgrade from prior practices where there were challenges and people were just not reporting the key stuff instead of they were very vague in nature. So potential enhancement and emphasis on investor education is still there is a scope for the same. However, when we talk about corporate governance and investment decision making process, please understand ESG factors play a critical role here. This is the last factor in three factors. We have covered environmental, social, and now the governance. What we need to see here is that traditional investment analysts prioritizes the governance among the ESG factor. While the CFA Institute 2017 ESG survey reveals that 67% of globally considered governance in analysis, which was 64% in 2014, people are considering. 54% globally considered that environmental and social factors are critical. You got the point? 67 says governance need to be understood, and 54% says that global environmental and social need to be judged. Then comes the academic research. Yeah, Friday, Bush, and Bashan in 2015 shows a clear link between governance and financial performance. Okay, and that's why you might have seen in the audit report itself, corporate governance reporting happens nowadays in a lot of jurisdictions. So good governance crucial. Good governance is crucial for long-term shareholder value, risk management, and societal prosperity. These are the three key pillars for the good governance. Why the governance failure, as seen in Enron, can lead to devastating consequences for shareholder. There are government impact and a lot of cases study which is available in the books as well. One of those where the governance is a fundamental, you cannot ignore it. Wrong decision, lack of alignment definitely erodes the value and pose risk for company sustainability. Theranos is one of the good examples cited in the book, says that 700 million loss has happened due to the board failure, ineffective oversight. Okay, means billions were lost, but 700 has happened. Means they have allocated because of the board were not able to pinpoint it at the right time. Uber governance adjustment in response to the scandals which they were facing affected the growth, which was quite exponential couple of years before. WeWork failed IPO is another good example for governance issue impacting the valuation of any company. Yeah, again, $1 billion company went to bankruptcy eventually, but their failed IPO was one of those examples. Importance of diversity in board supported by academic study, showing that positive relationship with the firm value. So the more diverse your board is, the better you will be in your peer group as a value of your script or share prices. Then comes the a governance failure definitely leads to fines, liability, falling revenue, and trust erosion. Slowly, that takes company to different route. One of the good example here, I believe, is Byju's. Integrating governance into investment process is three things which you have to think through. First, you have to put threshold assessment, look into risk evaluation, and inclusion in the valuation model itself, whatever you find as a risk in the governance. Then comes the stewardship dialogue. How a company is showing its leadership capability. And look, this term stewardship is what is all about next chapter. Okay. How a firm can create stewardship or leadership need to be learned. And there are step-by-step suggestion which CFA Institute makes that how you can create that with certain case study. We will learn that. Governance relevance across various asset classes, including fixed income, private equity, property, and infrastructure need to be also seen. See, in the government debt, sovereign debt, yeah, right now we are listed in MSCI US index, and that's why we were able to attract more than $1 billion just in 10 days time. Yeah, the governance evaluates the effectiveness of the state itself, rule of law, business environment for economic prosperity through the corporate governance lens. So all this decision making in ESG, which happens at the investor level, definitely considers corporate governance as key. I still remember Jhunjhunwala's statement, Rakesh Jhunjhunwala, who was the Warren Buffett of India. Before dying, he made one very simple statement that he always invested in a company which has a good board of directors and management. He never invested in a company which was value or growth company. Okay. And that is why corporate governance is a key idea for any success of any investment. With this, I close the session for today, but I am open for any questions to be answered. Thank you. Any question?
Hello.
Yeah, please, Nilesh, go ahead.
I have one question. Which